All right, thank you, and good afternoon, everybody. First off, I will say a quick apology if my voice sounds a little bit nasally. My office got hit with the flu this week, and I'm just getting over it. I missed most of the work week this week at home sick, so this is my first day kind of back in the saddle, so to speak, so I'm still a little bit nasally, a little bit under the weather. Thank you for hosting. This is a great event. And what I'm going to talk about here for the next 45 minutes or so, and it really does have a nice kind of flow from your last presentation, I'm going to continue on with the Elliott Wave concept and show you the advanced get concepts of Elliott Wave trading. And then what I'm going to do is I'm going to take some of those Elliott Wave models that I've been trading with personally for, this is my 18th year now trading, and show you how I've kind of transitioned myself from a futures day trader, which I've done for the majority of my career, into now more of an equity options trader. And the reason why I've kind of switched, and I still day trade futures every now and then, don't get me wrong, I still love doing it, but I tried to transition myself in my career because I really got tired of sitting behind a screen for 8 hours a day watching 2-minute charts and 3-minute charts and 5-minute charts and, waiting for that 4 or 5 trades a day where you're jumping in on it. And, a lot of people look at day trading as, oh, it's so much action. It's not really a lot of action. It's a lot of sitting and watching. And I try to, as I get later and more into my career, I'm trying to transition myself into more of a laid-back trader where I'm not sitting in front of my screen for 10 hours a day looking for those 4 trades. I'm trying to position myself to have more trading opportunities using the same strategies and concepts that I've been trading with over the last 18 years, but a little bit more relaxed method. Okay? So I've kind of transitioned myself into the options world a little bit more, and the reason why I like options, it's not so much because, everybody hypes up options for limited risk. You can only risk your premium. Yeah, I get that. It's not about the limited risk. It's one of the things that drives me to options is the leverage. One of the reasons I never traded stocks back in my early days of trading, even through the dot-coms and all that, is it required a lot of money. Options give you leverage just like the futures markets do, so I love that about it. Another thing that I really like about options is the opportunities. When I'm day trading back as a futures trader, I watch the E-minis, the euros, occasionally crude oil, maybe gold, sometimes the bonds or notes. There was really only about 3 or 4 markets that I really actively watched. With options, and if I'm doing this on a weekly side where I'm trading the weekly options, there's 200 or 300 markets that I can watch. And if I want to just look for the big movers, I can bring that down and I can look at 200 markets and just watch these markets consistently on 15-minute charts and 30-minute charts. And I'm going to show you how to do it using the advanced get system. And then what I'm going to do is I'm going to set the trade up from the technical point of view using the eSignal advanced get. And then I'm going to show you how the Options Analytix platform will now start helping you build the option trading strategy. Because a lot of people tend to forget, when you're an options trader, it's still chart-based. You still have to have market direction. That's critical. Options trading is not just about buying a call. If you're buying a call, you want the market to go up. So step number 1, and that's why I've got this mechanical trading process on your screen, step number 1 is still establish the market direction. If the market's going to go up, there's option strategies that we can do that'll help you trade that. We can buy a call. That's option strategy 101. Well, there's also things like bull call spreads. There's bull put spreads on the credit side. There's a lot of different option scenarios that you can play in that position. Now, a lot of that is going to depend on number 2, the volatility of the options market at the time. If options are overpriced or expensive, and I'll show you how using Options Analytics we can determine that very, very quickly. It's just looking at the differences in historical and implied volatilities. That's going to direct us to a particular option strategy. Are we going to do a credit spread? Are we going to do a debit spread? Then we need to build the option strategy. Which option is the best to do? Should we do a call 1 month out? Should we do a bull put spread out on these particular strikes? Again, using Options Analytics, I'll use our Spread Select tool, and I'll show you how we can very quickly go through the different trade setups and see which one has the best reward risk candidate for us. And I can quickly go through that and build my spread quickly. Then the most important thing. This is one that traders, and I still do a lot of mentoring. I teach advanced get still to this day. This is one of the things that traders have a hard time going back to. I've had a lot of clients that have done this in the past. You know, I'll go and do a mentoring. I do 4 hours a week of mentoring on advanced get. And we'll identify these trades on Tuesday night. And I'll say, this is a good Elliott type 1 buy, which I'll explain to you here shortly. And they'll go out and take the trade on Wednesday morning and the market's down. Triggering the trade is a very important concept. What we're going to do today, and I'm not going to show you 3,500 slides here of what you could have done back in 2012 on stocks that went up 2 years ago. Okay, I'm going to focus on the here and now. We're going to look at current markets. So I don't have any examples for you guys of, hey, this was a winning trade 2 years ago. I don't play like that. I like to use current markets. So trigger the trade is all about waiting for the market to respond to what direction you thought it was going to go. I'm going to show you trading examples today. On Monday, if the market goes up, you can trigger the trade. On Monday, if the market goes down and we were expecting it to go up, you don't trigger the trade. You trigger the trade when the market responds to the direction you predicted. You don't buy a market when it's going down. You wait for the down to stop and the up to start. It's not about trying to buy the market at the lowest tick. It's never going to happen. It's about waiting for the low to stop and the market to start coming back in your direction. And then finally managing the money. Now on the option front, it can be a little bit tricky because there's a lot of different things that factor into options pricing. You have to worry about changes in volatility. You have to worry about theta with time decay. You have to worry about, you know, gamma and things like that. There's a lot of things that can affect options pricing. Sometimes in the options world, the most profitable portion of your trade is not going to be, and I'm just kind of like right now we're talking about bullish positions. If a market goes to 105 and then later goes to 108, your highest profits on an option trade may have been at 105 and not at 108. So you need to map your position out accordingly to pricing. And sometimes, like I said, that highest profit is at a lower price in the underlying. So that's the tricky part of options, and we have some tools in Options Analytics that'll help us identify this and help us track the trade so we can get the most out of it. Okay? All right, so that's my little outline of what I wanted to accomplish for today's session. Now, what we're going to start with very quickly, and like I said, the last presentation you guys saw was a good Elliott Wave primer, so that kind of saves me a little bit of time, and it was some very, very good information. Okay, so this will kind of get you going in our direction with Advanced Get. What I want to introduce you to is the Type 1 trade from Advanced Get. Now, we have a couple advantages in Elliott Wave with Advanced Get. First and foremost, Advanced Get's been on the market since 1987. It was acquired by eSignal in 2000, so you know this software has been on the market for a long time. It's been around for a long, long time. Tom Joseph developed it back in the early 80s and then finally released it in 87. And I actually still work for Tom Joseph, who wrote Advanced Get. Tom also wrote the Options Analytix add-on that you're going to see today. So there's, you know, some connection there, which is why I still use the two products. All right, so bear with me for just a second. I'm going to switch over to eSignal eventually here when I find the right screen. All right, there we go. There's eSignal. I know it takes a second or two. Okay, and hopefully your screen will pop over. All right, let me, there we go. All right. Hopefully everybody can see my screen. This is the spiders, SPY. Now what I want to show you this particular screen for is just because I want to show you the underlying concept of Elliott Wave. I know you guys just had a pretty good course in the last hour on Elliott Wave, but I want to just give you a little bit of a refresh of what we're looking for. When Tom Joseph did his Elliott Wave research back in the late 70s and early 80s, what he was trying to do was not master every single portion of Elliott Wave 1, 2, 3, 4, and 5. On a layman's terms, in a very simplistic manner, Elliott Wave is the theory that a market trends in 5 waves, 1, 2, 3, 4, and 5. At the end of a 5th wave, the market is either due for a major correction or a complete change in trend. Okay? Now, what Tom found through his research was that the most predictable Elliott sequences And the best Elliott sequences for you to enter into the market are during Elliott Waves 3, 4, and 5. All right, so if you look at the spiders, this is your Elliott Wave 3, this is your Elliott Wave 4, and this is your Elliott Wave 5. Okay? That sequence right there is the most predictable for you to trade in, 3, 4, and 5. Now, we only have 45 minutes today, so I can't break down every individual Elliott sequence with you, unfortunately, so I got to focus on one. What Tom found through continued research was that Elliott Wave 5 was the most predictable pattern to trade. Now, there's a little bit of give and take with this, right? Because if you look at this market and you look at this sequence, I know from personal experience the first thing that you're going to want to see is, all right, Ron, if you're saying that I can trade Wave 3, which the S&P rallied from, this is the spiders rallied from 187 to 207, or I can trade the 4, or the 5 technically, that rallied from 197 to 212, why would I want to trade that little 5-wave sequence over here when the 3 is much bigger? Well, like I said, everything in trading is a give and take, right? Wave 3 does give you more profits. The problem with Wave 3 typically is, in study and research, it's a little bit harder to predict. It's a higher risk trade with higher rewards. Now the Wave 5, that little move over there from where the 4 is labeled to the 5, this is a much, much lower risk trade with a lower degree of reward. But the key is it still has enough reward risk to be a very profitable trading system. Now here's the great part about combining this with options. We can take this pattern, which is a very, very high or a very, very low risk pattern. We can combine a low risk pattern with a high probability options play, and we can pick up some serious money during this 4 and 5. Now, one thing that I've learned about trading over the years, trading, if you want to put it into, a baseball term or even a golf term, right? I do a lot of golf. My brother golfs as well. Now, when I golf, I don't hit the ball very far, but I can hit it pretty straight. My brother hits the ball a ton, but he's off the fairway, he's in the woods, he hooks the ball. I hit the ball slow, straight, and on the fairway. And I can beat him because of that. He can hit the ball 350 yards, but if he can't find it because he's in the trees, that's a problem. It's like baseball. Now, baseball before the steroid era, okay, the home run hitters of the day, the big home run hitters. If you hit 60 home runs a year, typically you probably hit 250 or 260. You were a low average hitter. But those guys that played first base, second base, shortstop, they didn't hit a lot of home runs, but they hit the ball 340, 350, 360. Trading's a lot like that. You're not going to hit a lot of home runs. Trading is about getting the singles, the doubles. Every now and then you'll hit a triple. Every now and then you'll get that home run. So what we're looking for in this kind of trading mentality, we're looking for the singles and the doubles. I'm looking for a high degree of success with a lower amount of reward. Now the key to this is, when I say low reward, don't let that scare you away. I'm looking for a positive return on investment. That means I'm not going to risk more than I lose along with probability. So I'm not going to be risking $1,000 to make $50, in certain instances. I'm only going to be looking for positive rates of return on this. So you'll start to see what I mean by that when I get into the individual options breakdowns. We're looking for usually smaller returns, but with a high degree of success. Okay? That's my goal. So what I want to learn how to do is I want to trade this wave 4 from its conclusion to the wave 5 high up here at the top. Because history tells us this is the most predictable Elliott Wave sequence to trade. And I've been trading this for 18 years. It really is a good pattern. And once you combine it with that good option credit spread, I'm going to talk about the bull-put spread today. The nice thing about the bull-put spread is if the options volatility is right, if the market goes down against you, you can still make money on the trade. It doesn't have to make a wave 5 for you to be fully profitable. This market can go sideways and you'll make money. It can go up 10% and you'll make money. It can go down 5% and you'll still be profitable on the trade. That's the beautiful part about it. Even if you're wrong on the market direction, you can still make money within certain degrees of movement. And I'll show you how that's done. Okay? So what I'm going to do is I'm going to quickly walk through you a type 1 trade. This is the eSignal 12 charting application. Now, as an advanced get client, this is what you're going to be using. eSignal 12 is a very powerful charting application. It's not just advanced get. We've got alarms, alerts. There's things in here where you can build your own studies. We've got integrated trading in the software from interactive brokers, tons of different brokers that we offer support with. There's all kinds of stuff you can do with eSignal 12. It is a full-fledged technical analysis package. We've got third-party add-ons. You even saw the previous presenter talk about, you can put his indicators into eSignal. eSignal 12 really is a fantastic technical analysis platform. It's the one where advanced get currently lies in. Okay? Now, one of the cool features is we have what's called replay mode. I'm going to take this chart and I'm going to jump back in replay mode to December 17th. Okay? Here is December 17th, and this is what the chart looked like on the spiders. Now, this right here is a perfect type 1 trade setup. Now, step number 1 of a type 1 trade is pretty easy. We want to see the market in an Elliott Wave 4. Well, that's what we've got currently labeled right here, an Elliott Wave 4. Step number 2 is to confirm that this is a viable Elliott Wave 4, because there's a lot of Elliott Wave 4s that develop, but not every Elliott Wave 4 is going to turn into a 5-wave sequence. Not every 4 is going to turn into a 5. We need to try to get the best evidence that's going to suggest this market is going to turn from a 4 into a 5. So we've got 3 rules that help us establish if this is the best market that's going to turn into a 5-wave sequence. Now, if this market does turn into a wave 5, you see those 2 hash marks up there? Here and then here? Those are your Fibonacci targets, so we're already laying those out for you. We should end in wave 5 somewhere between 209 and 217. Okay? Those are your Fibonacci wave 5 targets based on 62 and 100%. Like I said, you got a good primer from this already from the last presentation, so you kind of know where some of this is going. Now, the advanced get way of doing this, and then let me take a look here. And then the question, are those Elliott numbers appearing on the charts one of your indicators, or was probably manually? No, those are automatic. All you do, I'll take them off the screen for right now. That's one of our advanced get indicators. Now, like I said, advanced get is integrated right into eSignal. You'll notice at the top of my charts, if you're an eSignal client, you've got your drawing tools button. There's also this little get button. That's the advanced get studies. You just click on get studies, and then get Elliott waves, left click. There they are. So they are automatically applied to your chart. Now, I will tell you this. One thing that I have turned off, because I don't, for demonstration purposes, I really don't like to bring them into the equation. We also do the intermediate counts too, the little minor ABCs, the 1, 2, 3s, the intermediate type counts. And there's some things that we can do with those counts, through our education that we offer to show you how to trade those as well. I usually just keep those turned off for presentations just to kind of keep you focused on the big wave 3s and big wave 4s and such. Okay? So that's what we're looking at so far. We're looking at a nice wave 4. Now it's time to confirm. We have 3 rules that help us confirm that this is a viable, tradable wave 4. Now, notice I didn't say that this is actual wave. This is a wave 4. It's a real wave 4. So I want to be careful in how I term this. I have 3 rules that will help me determine if this is a tradable Elliott Wave 4. Because it's a wave 4, but now I need to see if it's got the best chance of turning into a wave 5, and this market's going to rally somewhere between 210 and 217. Well, rule number 1 is that oscillator on the bottom. The oscillator was one of Tom's creations back in the 80s, released with the original advanced get. The oscillator is nothing more than 2 moving averages. a 5-period moving average, and a 35-period moving average. That's all it is. It's a strength tool. It goes on to Elliott's teachings. Wave 3 is very strong. Wave 5 is not as strong. So we have to have a study that helps us identify market strength. Now, you'll notice that during the wave 3, that oscillator generally grows very tall. Okay, it's like a big mountain up here. There's a black band that runs through it. This black band is a strength band. And as long as during wave 3 that oscillator rises above that black band, it's just telling you that there's market strength. Now, during wave 4, this is where the key part comes in. During wave 4, the market's going to retrace. It's going to pull back. We've declined from about 208 down to about 197. Okay? The market's pulling back, and it looks like it's getting weaker. The key is it's okay for the market to get weaker. It just can't get too weak. Now, what Tom described and what he found in his research is that as long as this oscillator doesn't retrace more than 140%, so let me explain that really quickly. If you measure the oscillator from the base, this right here is the base, okay? If you measure the oscillator from the base to the top, if the oscillator returns back down to the base again, that is a 100% retracement, okay? It retraced 100% from its top. If it goes below the base like it's done here, that would be like a 110% retracement, 120. We can just simply go in with one of our Fibonacci levels and measure it. Okay? And here's what you see. This down here, that red line, is a 140% retracement. Tom's research showed him that if the oscillator stays above that 140% retracement in conjunction with a couple of other indicators coming in, that this market has the best chance of success to complete the 5th wave cycle. So right now, the oscillator supports the S&P rallying to make a 5th wave. So while everybody during this retracement is saying, oh my gosh, this is the big correction, the market's going to go to, Dow 1,000, S&P to 1,500. I'm getting a little bit, satirical with that, don't get me wrong. But, everybody's predicting doom and gloom. This market's still hanging on by a thread. We still got a chance here, okay? The oscillator is still showing us some overall strength. The market's still got a chance to come back up and make that 5th wave high. So we've got 2 rules in place. Wave 4, and now the oscillator supports the strength of this market, and it still gives us a chance to rally back up into a 5th wave. Okay? Now, rule number 3 is this number right here called the PTI. Now, the PTI is one of the easiest tools in the world to use. It's just sometimes confusing to interpret because it's so easy to use. It's kind of funny in this way. The PTI stands for Profit-Taking Index. And all the Profit-Taking Index does is it looks at how much we've gained during the 1, 2, and 3 and how much the market gave back during wave 4. It computes itself into an index that ranges between 1 and 99. As long as that index number is greater than 35, it's good. If it's 35 or less, it's bad. The reason why I say it's often confused is because people will look at a PTI of 72, then they'll look at another chart with a PTI of 80, and they'll assume that the 80 is better than the 72. It's not how it works. A PTI of 40 is just as good as 80. PTI of 70 is no better than 37. So it's very easy, but some people just read a little bit too into it. Right now, the PTI is 72. Okay, it's good. That means we haven't given too much back of the original 1, 2, 3, rally. We're still in good shape as far as price. The last thing we look at are these channels. You'll see a blue channel, a green channel, and a red channel. These are our wave 4 time channels. All these wave 4 time channels are moving averages. That's it. They're just moving averages. What moving averages are they? I could tell you if you really wanted to know, okay? Or you could figure it out yourself if you really wanted to. All you have to do is put a simple moving average on the chart and adjust it so you get to the lines of the channel. It's not important how they're done. What we do is we look at the structure of 1, 2, and 3, and 4. Okay, we look at the structure of the wave counts. We look at the ratios, and then we input the ratios of 1, 2, and 3 into a proprietary calculation, and that calculation spits out 3 moving averages for you to watch for wave 4. Now, the interpretation is the key part. If the wave 4 trades up to and doesn't take out that blue channel, that first one, then this market has an 80% chance of completing a fifth wave rally. Well, we've taken out the blue channel. We've gone past it. Now, the next channel down, and I know it's kind of weird because I'm pointing a blue arrow at the green channel. The green channel, okay, has a 60% chance. If we stay above the green channel and the wave 4 is good and the oscillator's right and the PTI is greater than 35, we have a 60% chance. Well, we've gone past the green as well. Now we're sitting on the red. Now, a lot of people, and the reason why I chose this chart is because this chart always generates a lot of questions from our users. We are sitting on the red channel. What do I mean by sitting on the red channel? If I draw this arrow through this red channel, what I mean essentially by sitting on it, we're not through it yet. The bars are still touching. The only way we are going to get through that red channel, and like I said, I know I got a blue arrow here. I'll make it easier, just so it's visually more appealing. I'll change that to a red arrow. That represents the red line. Okay? The only way we really get through that red channel is by having a full bar below it. I want to see the high and the low of the bar completely below the red channel. So right now we're sitting on the red channel, and that's our last line of defense. As long as we are at or above the red channel, we still have a 50% chance of making a new high. So the next trading day, if something like this comes in and the bar opens up and does this, I would no longer consider that a valid trading wave 4. I wouldn't want to go along the S&P. So at this point right here, we've got a viable wave 4. This market has a good chance to complete the fifth wave rally. Now what, of course, does it do? The next trading day, boom, it completes the fifth wave. One trading day, boom, it gaps up. You could have bought it right off the open because guess what? The market rallies the next day. We go up, and you could have made all your profits in that one trading day. That was your chance. You missed it if you didn't take it because then the market just kind of settled sideways for the next couple of days. Okay? But that was really your chance. Now, that happened very, very quickly, and that's rare for that to happen. The normal sequence of events for this wave 5 to occur is typically about 15 to 20 bars. So, and I know Ben on the previous presentation talked about how Elliott Wave works on all types of markets and all types of, time frames, and he's absolutely right. I concur 100%. What I've seen over the course of time with Elliott Wave is this 4 to 5 wave sequence takes about 15 to 20 bars typically. This is a very unique event where that happened all in one day. Okay? So think about that, 15 to 20 bars. And the beauty part about this is if you're just trading stocks, you don't have to trade the options part of this next. You can just trade this particular pattern on your stocks. If you're trading S&Ps or Forex, just use this sequence, this concept on Forex. You don't have to take it to an options. You can just trade that pattern right in the currency markets because it works in any market. It works in any time frame. If you're trading this on a 3-minute chart, that type 1 trade will last you about 60 minutes, typically. If you're trading on a 60-minute chart and you're trading it on a currency, it's going to take you about 15 to 20 hours to complete that type 1 trade. Again, it's about a 15 to 20 bar trading sequence. Okay? What you saw there was a statistical anomaly for that to happen like all in one trading day. That doesn't happen often. Okay? It's very, very rare. But that's the type 1 cycle that we're looking for. Okay? All right, now, what I need to do is how do I get these trades? How do I find a good type 1 candidate? I don't want to have to go through 5,000 different charts to do this. Here's how you do. In the advanced scat system within eSignal, I'm going to click on New, and I'm going to click on Scanner. Okay? I'm kind of hoping everybody's chart is updating to this. All right, good. Just making sure. I was looking at my little presenter view. All right, this scanner kind of looks like a spreadsheet. What I can do with it, I'm going to click on this little filter icon, and I'm going to go over to my filters, and I'm going to choose portfolio. Instead of doing stocks, I'm going to do optionable stocks. All right, I'm going to set the minimum price. I'm going to set the minimum price to about 35 because I'm looking for credit spreads now. What my goal next is, I want to look for potential trading opportunities that are going to give me a good credit spread. So my base is I want to find a good type 1 trade. I want to find a good bullish market pattern. Then, instead of buying calls on it, I'm actually going to sell some puts. All right? I'm going to sell some out-of-the-money puts. The reason why I like to do this is because if I think the market's going up, if I can find a good expensive put to sell, I can take advantage of that credit even if the market comes down against me a little bit. It's a much higher probability trade. And you'll see how this works when I set up the trade in Options Analytix. Okay? And if I have time, Richard, I'll try to show you another opportunity or another trading example as well. I hopefully can get some time for that. All right. So I'm going to set the minimum price to 35. I'm going to set the maximum price. I'll just kick this up to 2,000 because there's some expensive stocks out there like Priceline. All right, so I'm going to click on Technical Analysis. I'm just going to look for daily charts, and I'm going to look for Type 1 buys, and I want to give it all the symbols. So I'm going to change that out to 1,000 symbols. I'll click OK. All right. Now, all of these stocks currently are in Type 1 trades. So let's look at Starbucks. If I right-click on Starbucks, I can open that right into a chart, and here is Starbucks on a daily chart. And let me tile that so we can see both screens together. So over here on the right is Starbucks. You can see it's right now in a wave 4. We actually had a rally on Starbucks up to about 83. It's kind of come back down a little bit with the sell-off we had Friday. So it's kind of sitting right at that $80 level again. This market has the potential to run up to about $86 to $92 a share. Now, once I've got these charts and everything synced up, I can just go click on eBay. You know, right here is a good-looking trading opportunity on eBay. 63 PTI. We're right at the green channel. It had a rally on Thursday. Friday it came back a little bit more, but eBay's got a chance to run up to about 62 bucks from the 55 that we're at right now. Okay, so from the option side, now what I can do with this is I need to start thinking about options. One of the biggest mistakes in my experience that option traders make is they'll look at a chart like eBay and they'll say, all right, eBay can go up to about $62 a share. I'm just going to buy a call on eBay because I think that's the right thing to do. The market's going to go up. I'm just going to buy a call. One of the biggest mistakes that option traders make is they don't understand volatility. Volatility is critical. Now, what we do with Options Analytix is we break it down. We've got this really easy indicator to use. I'm going to take that chart of eBay, and instead of right-clicking on it and opening it in eSignal, I'm going to choose the next option, which is Open in Options Analytix, and I'm going to open it into an Options Analytix chart. Now, what should be popping up on your screen is that same eBay chart, except now it's in Options Analytix. This is a plug-in software that works right alongside of eSignal, okay? But they link from between each other, so you can open up charts from within eSignal in the Options Analytix world. This is that chart of eBay. Now, what I'm going to do is I'm going to right-click. I'm going to add one of our proprietary option studies called Options Over and Underpriced. Now, what this study is going to do, and you can kind of see it in the Properties menu here, it's going to compare the continuous implied volatility to the historical volatility. Now, when you compare those two volatilities, we will get an idea of whether options are over or they're underpriced. When the implied volatility is much greater than the historic, options are expensive. When the historic volatility is greater than the implied, options are typically inexpensive. So let's go ahead and apply that study on eBay, okay, and we'll get a read. Right now, eBay would be an absolutely terrible stock to buy a call on. So if you think eBay is going to go up, do not buy calls. Because looking at this indicator, options are extremely overpriced. Now that study in the bottom of your screen kind of looks like an oscillator. When the oscillator is high like this, in that green color, that means that your implied volatility is much, much higher than your historic. That gives you a very, very high options price. Now the problem with high options prices, a lot of people look at this and say, well, Ron, so what? If I buy a call, it's going to be $10 instead of $5. Big deal. The problem is eBay is going to have to make a dramatic move in price for you to overcome the expensive premium. That basically means that if eBay goes up to, 59 bucks, you may not make any money on this trade. I'll show you what I mean. I'm going to go into the projection tool of Options Analytix. I'm going to put eBay in here. Okay? If you buy right now a February 20th $55 call on eBay, and if eBay rallies to the previous high, okay? Now what this projection tool is, this is basically a simulator for what your options will do. It's kind of like a risk graph, but a lot more. This little line right here that's attached to the daily chart of eBay, what I can do with this line is I can kind of go back and forth, and I can predict day-to-day price movements on eBay. So if eBay does a pattern similar to this, where it rallies and declines and rallies and declines, this is your profit and loss on eBay through the trade. So if eBay rallies to $56 on January 17th, you'll be up $40 in your trade. If it declines down to $55 on January 21st, you're going to lose this amount. It's basically a trade simulator, a day-to-day simulator. And what you can do is you can also project volatility. This is the volatility on eBay. Right now, eBay is high volatility. Well, what happens to your profits if eBay drops suddenly on volatility? You can kind of see how your profits decline with it. So the reason why I bring this up is I want to show you what happens if eBay rallies to that previous high at about $58. Wow, you made $32. It's impressive. eBay just moved from 55 bucks to 58. The stock moved $3. If you bought 100 shares, you'd have made 300 bucks on eBay. The option only gave you a $30 profit. 30 bucks. It's not a lot of money. $30 profit when the market made a new high. What if it goes to 60? Right? That's a big move. It went to 100. You made $170 in your option. eBay went to 60 bucks. It rallied $5 a share. You made $170. That's not the kind of returns that you're looking for in an option. Okay? The reason why your profits are very, very small in this case, even though eBay's rallied to new highs, is because options are expensive. You don't want to buy an overpriced option. Now, I'm not saying that eBay is not a good trading opportunity. It is. But this is the exact kind of trade that you want to take with a credit spread. Options right now on eBay are expensive. When options are expensive, you don't buy them, you sell them. So you would want to sell an option here. If you think that the market's going to go up, you would buy a call. On the credit side, if you think that the market's going to go up, you sell a put, right? A put gives you the right to sell an option or sell a stock. So if I take eBay, right, and I think that this market's going to go up. eBay we projected to go up to about 60 bucks a share, right? If I sell a put at $54 down here, guess what? That put shouldn't expire with value. It should expire worthless. That's what I want it to do. The market's going to go up. For eBay, if I sell that $54 put, I should get the full credit for it. Now, you can sell a naked put if you want to, if you have the money to back it up. It's a lot of risky trading right there by selling naked puts. So what you typically do, instead of just selling a naked put, you might sell a 54, and then you would buy a 53 to protect it. All right? So let's take eBay as an example here. I'm going to take eBay, and I'm going to bring it into our Spread Select tool. All right. Now the Spread Select tool, what that does is it's going to allow you to select from over 30 spread candidates. I'm just going to do a bull put. You know, you got bull calls, synthetic longs, put ratios, bear calls, condors, and all that kind of stuff. All right. I'm just going to choose bull put spread. Now I'm thinking February 20th is fine. Now one thing I will tell you about stocks that have high volatility stocks are oftentimes induced by upcoming earnings. Earnings are bad to trade typically when you're a directional trader. So you want to make sure that you can get out of the position before the earnings announcement comes in, because that can play havoc into the market. So a lot of times what I'll do in a case like this is I'll make sure I'll just go to the news, or you can even do it within eSignal and say, all right, when is eBay's earnings coming out? Well, eBay has earnings on January 21st. That's still, calendar-wise, that's still a week and a half away. I can make money on eBay. If you want, you can actually set a bull put spread to expire before that. Okay? But that's okay. You can trade this thing for the next week and a half for a bullish market up until the earnings announcement. So I'm going to set this thing to go ahead and just expire on February 20th. I'm going to set the direction to below, because I don't want to buy in the money puts. I want to buy out of the money puts. And then I'm just going to set this thing to build me a couple of strikes so I can look at some candidates. And then, TJ, to your question, absolutely. You can scan for short candidates. Instead of doing type 1 buy, you would just do type 1 sell. That's the same basic pattern except the 5-wave candidate down. All right, so here's a couple bull put spread opportunities. Now, what I want you to focus on is this stuff over here, okay? These columns all the way over here to the right. This right here is the credit that you'll receive if you place the trade. So let's focus on this one right here. It's an $81 credit, and by taking this trade, you're assuming a $168 risk. Now, from an options trading perspective, this is kind of reverse in some cases from what people think. Like a regular trader thinks, I would never risk 80 bucks to make never risk 160 bucks to only make $80. In the options world, it can be okay because of the probabilities. Now, I'm not saying that this trade is okay. I'm just saying that it might be okay because of the probabilities. Now, this probability right here, 41.1%, this is based on volatility. That means that this $55 put that you are selling has a 44 or 41% chance of finishing in the money. That means that if you take this trade based on volatility, you basically have a 60% chance, I'm rounding a little bit here, you basically have a 60% chance of this trade working. Okay? You have a 60% chance of this trade working. So what you have to do is do a quick return on investment calculation. If I take that trade 10 times and it works 60% of the time, and I make $81.50 6 times, I'm going to make $489. Well, if I lose $168 4 times, I'm going to lose $672. That trade, even at a 60% accuracy rate, will not make money for me. It's not a good trading opportunity. Okay? It doesn't work. I need to make sure that I can take the trade 10 times and have a positive return on investment. eBay from this side of credit is not a good opportunity. Okay? Now, you don't necessarily need eSignal. You can actually you need eSignal's data to run the Options Analytix platform. You do need eSignal, the platform itself, to have the advanced get. But to run Options Analytix, we have a package where you just pay for the data feed that you would need and then run Options Analytix as a charting package. So eBay is not a good opportunity. Now, what I can also do, I'll switch back to eSignal real quick here. I can actually take all of these symbols in my scanner, and I can go into Options Analytix, and I can go into our scanner called the Matrix. I can go into a Matrix scan list, and I'm going to take all of those symbols from the eSignal Advanced Get Scanner. These were all the Type 1 trades that were found. These were all the symbols for the Type 1 trades. Now, what I'm going to do very quickly is I'm going to go to Scan, and I'm going to scan the market for overpriced options. So instead of going through all those stocks over on the eSignal side and doing it manually, I'm just now looking at basically, every stock that has overpriced options. And this is a list. So these are the ones that I can focus on if, I really want to just try to get to the best trading opportunities. Here's that nice big list of stocks. I'm just kind of scrolling through them here. Now, another thing that you can kind of do with the matrix, there's a lot of things that you can do with the matrix. This is our real-time option scanner. For those of you that trade a lot of options, you can look for increases in cumulative implied volatility. You can look for increases in percentage range, historical volatility. We've got scans in here for candlesticks and 3-bar reversals. We've got scans where you can do bear put call potentials, covered calls. There's all kinds of things that you can do with our scanner. It's a really, really in-depth scanner. Now, one of the stocks that came up in the scan on both of these was Yahoo. Yahoo is an example for a good bull put or a bull put spread. Let me go ahead and I'll just build one for you real quick on Yahoo.
Hey, Ron, don't mean to interrupt, but you got about a minute, 2 minutes left.
Okay, thanks. All right, so here's one on Yahoo. You take a look at Yahoo. Here's a trade right here, 34%. That trade has a 65% chance of success. This is selling the 48 put, buying the 47 put. $39 credit with only a $61 risk. This is how you build the trades. Now, what I can do is I can take that trade, put that right into my projection tool, and a little bit of a glitch there. Sometimes I don't link my charts properly. There we go. Try to get through this pretty quick. All right, so here's Yahoo. Now, the beauty of this thing is, as long as Yahoo stays above, at the end of the day, 47 bucks, that's right where you'd put your stop. This trade becomes a full win. So if the market goes up, you're in good shape. As long as we stay above that yellow line right there, this market, so even if we go down, you still make a little bit of money. All right, since I don't have a lot of time, I want to just kind of give you guys a couple things here as far as what we've got to offer you on the eSignal side. All right, the advanced get. The advanced get is really, it says $295 a month, but that assumes that you have an eSignal subscription, which is going to cost you about $150 a month. Advanced get is going to cost you about $450 a month to lease. It's about a $450 a month lease. You can also buy it. It's a one-time fee. Now, the beauty about buying advanced get is you own the software. There is no upgrade charge. There is no renewal fee, nothing like that. It's a $32.95 price. You buy it once, you own it, okay? That includes eSignal 12. So you purchase the eSignal application. You now own it. The only thing that you're going to have to pay for is a month-to-month data fee. Now, because you came to the webinar today, we offer a $700 discount to Advanced Get. You are eligible to purchase the Advanced Get add-on or the Advanced Get system for a $700 discount. And I'll kind of put these, I'll put that email into the chat window if I get a chance. You can call our 800 number, or you can just mention that you were at this Saturday class. They'll know exactly what you're talking about. And you have a $700 discount off Advanced Get. Now, that Advanced Get, by the way, comes with 3 months of training. We do 6 hours a week of live education. We also have a bunch of stuff on the internet that you can kind of look at as well. And I can give you a link to that page. That page that I showed you that had all the Advanced Get information on it, that's this page right here. Take a look at that page. Okay. This also has the features of Advanced Get. It's got specials that we have. It's also got an overview. You can kind of take a look at some video of our core strategies and everything that you really need to know about Advanced Get. Now, there's also another link I can give you for Options Analytix. Now, Options Analytix is an additional charge. We typically charge $250 per month for Options Analytix. Right now, we have a 50% off promotion. The first month is $125. Now, you can buy lease Options Analytix separately. Okay, you can do it. You don't have to have the eSignal 12 subscription. You can just use Options Analytix as a standalone charting engine as well. It's still going to cost you that $250 per month, or the first month is $125. And you can kind of see down here, available as a standalone or an add-on to eSignal. Okay, so now the Options Analytix also comes with training. We do a once-a-week session, mentoring on Thursdays, where I teach the different parts of Options Analytix. We've got some quick video tutorials on a few of our indicators down here. So lots of stuff you can learn from there. And then you can also just go to our eSignal site and kind of take a look at those different products that we have to offer. Okay. Options Analytix, it will work for intraday day trading in a certain sense. Okay. The risk graphs, things like that, it's really designed more towards daily charts and higher. But it will work in a certain sense. I mean, I use it for weekly trading when I'm setting up some stuff just to kind of get some projections out there for intraday. But to be fair, it's really more geared towards swing trading on up. And then, yeah, the advanced get stuff that I talked about first, you know, the type 1 trade on the S&P, that is totally perfect for anything. You can use that concept on futures, Forex, stocks, mutual funds. It works for anything. So you don't have to even bring in the option side of that. You can, you know, I used advanced get for 18 years trading nothing but futures, you know, before I kind of made the switch to options. So it works very effectively on that for 3-minute charts, 5-minute charts, etc. It works great for that. When you use it as a standalone, you still do have to have an eSignal data feed. Now, that $250 a month price right there for the Options Analytix, that covers the data feed. So there is no additional charge. That includes the eSignal that you need with it for that $250. Now, also, if you do attend, or if you do hit that Options Analytix or even that eSignal website that I gave you in the chat, we do have links on each page for the training webinars. If you click here for record, we can give you some recorded events. All right, it's 1:50, so unfortunately I do have to make way for our next presenter, but I do want to thank all of you for attending. I'll give you guys my email address if you want to get a hold of me. I would be happy to answer any other questions you have via email. But thanks once again. I appreciate the forum here from Investor Inspiration. It's a great venue here, and thanks once again to everybody for attending, and hope to see you all in the future. So thanks again.